All right, everyone. This is my money brief. My name is Ugo, and this is brought to you by Nairametrics. All right, on today's money brief, I want to touch on public offers, right issues, and share prices. I got messages asking me to explain the difference between the three. There's been some confusion, and I can understand why. These days, you tend to see public offer prices and right issue prices trading differently, different cost. And of course, the stock itself now has a different price on the market. So let's say the public offer price is say 5 naira, the right issue is 4 naira 90 kobo, but the stock is trading at 4 naira 85 kobo on the market. So three different prices: 4 naira 85 kobo, 4 naira 90 kobo, and 5 naira. And I guess you're wondering why. So a little bit of history. In the past, when stocks were trading, they when stocks had public offers or right issues, their share prices used to be frozen, and so that way, you won't, you know, the share price for the public offer and the right issue would usually be the benchmark price, and at that time, you wouldn't even bother looking at the market price because the market price just be frozen. That's how it used to be done before, until it was changed over a decade ago, and now the market just determines the price. Because I guess the exchange thought that that system was old-fashioned and was often manipulated. So think about it. If I wanted to bring in a stock, I wanted to do a public offer, and the share price was say 4 naira or 3 naira, I could basically just manipulate the share price and it would go up to 5 naira, and then I will now just quickly do a public offer at 4 naira 50 kobo. Make it sound like I'm giving you 50 kobo discount, and then everybody go and buy, and then of course it will be frozen at 4 naira 50 kobo, and then everybody will go and buy. And then after the public offer, the share price will just crash back to the 3 naira that it was before, and then everybody loses money. That was what it used to be like back then. But that has changed now, and the exchange has said, you know what, no more doing that. Let the market determine the price. So if you want to sell at 5 naira and the share price is at 3 naira, that's your business. The market will determine, because if you're doing your public offer at 5 naira and the market price is 3 naira, there's no point buying the public offer. You just go to the market and buy. Because it's cheaper in the market if you really want to own that stock. And so that system has changed, and that is what has led to what we have today. So in today's market, I'm sure you've seen cases where the right issue price, the public offer price, and the market price is completely different, and I would explain why. The right issue price would often or most likely always be lower than the public offer price, because right issues are meant for existing shareholders of that company. So people who already have shares in that company. So they're just giving you an opportunity to buy some of those shares in proportion to what you had. So they'll tell you, if they tell you, for example, 1 for every 2, it means is that for every 2 stock you have, you're going to give you an extra right to buy 1 of it. 1 for every 1 is for every 1 you have, they give you a right to buy 1 more of it. Okay, so that's basically how it works for right issues. And so because it's an incentive to existing shareholders who have bet on that company in the past, their share prices are often lower or at a discount to the public offer price. Now, the public offer is for everyone, including existing shareholders. So anybody who, particularly those who never had shares in that company, can buy shares in the company. Then the market price is a separate thing entirely. That's just the market saying, this is how much we think this share is called, our own value of the shares. We don't really want to know what's going on in the public offer. But here's what I know though. Most times, the public offer price, or the market price rather, would often range or fall within the public offer price. So let's assume that the share price of that stock was 20 naira, and then the public offer price is 19 naira 80 kobo. The market price would often fall between that 19 naira 80 kobo and 20 naira, or slightly lower than 19 naira 80 kobo, just within that range, if the market believes that that public offer was well priced. But if it's not well priced, it is very, very likely that the market price could even fall way lower than that 19 naira 80 kobo, using that as an example. So that's basically how this works. Now, to the next question. what do you do? Do you buy the public offer price, or do you buy the right issue price, or do you just go to the market and buy? It's a very important question, but here's what determines what I do if I wanted to make a decision. If I was going to buy on the market, I look at my cost, because whenever you're buying straight from the market, there's a cost. You pay your stockbroker a fee. I think it's about between could be between 1 to 2%, depending on which stockbroker you're using, and of course you also pay taxes as well. But when you're buying a public offer, a right issue, you don't necessarily pay that fee. So at least, correct me if I'm wrong in the comment section, but the ones that I've recently just bought, I did not pay any. I don't recall any fee being charged for the offer that I bought. I just bought it straight up, and there was no charge. But even if there's a charge, the charge is usually very, very low compared to how much you pay if you're buying straight from the market. So that is the math that you got to do. So you have to look at, if you wanted to buy, say, 10,000 units of a stock, or 100 units of a stock, or 1,000 units of a stock, multiplied by the market price, and then the cost of buying it, and then compare it to how much you would have also paid at the public offer price. I think that should determine which one you want to go for, whether you want to go for the market price or whether you want to go for the public offer. It's a very simple math to do. And bear in mind that public offers sometimes take time before you eventually get those shares to start to trade. But if you buy it in the market, you're trading it as anytime you want to sell or buy, so long as there's somebody on the other side who's willing to buy or sell from you. So you can always trade that one. So that essentially is the difference between the public offer, the right issue, and the market price. So just to recap, if you wanted to buy or to buy any of these offers you're seeing, you think maybe it's better for you to go and buy straight up from the market, just look at the cost, what is going to cost you from your stockbroker perspective. Compare that to the cost of buying the public offer and the discount between, of course, especially this only matters when the market price is lower than the public offer price, isn't it, or the right issue price. But if the right issue and the public offer price is lower than the market price, then I just think it's a no-brainer. It just makes sense to buy straight the public offer or the right issue. No-brainer. No buying in the market. Just buy public offer, right issue, because they're selling at a much lower price. But if the public offer and right issue price is higher than the market price of the stock, which you can buy through any stock broking app or any stockbroker, just check the cost. That should help you decide better. All right, I hope I addressed this pertinent question. If I did not, drop a comment and I will maybe put a bit more explanation. So that is my morning brief for today, and do have a profitable day ahead. Bye.